Every month you leave retained earnings sitting inside your corporation account doing nothing, you're losing money to inflation. Even if you're getting 1 to 2% in interest, your cash is worth less in real terms, and you may be potentially setting yourself up for a big tax problem. Here's what you should be doing with that idle cash sitting inside your corporation. My name is Quinton Chambers. I'm a financial planner and portfolio manager, and I build total wealth plans and manage portfolios for business owners, incorporated professionals, and affluent Canadians. After more than a decade doing this work, one thing is clear. People just like you are leaving real money on the table, and on this channel, I try to show you how to put it back in your pocket. So picture this, you're running a successful business. Your account tells you that this year is looking great and you're gonna have retained earnings. After all of your business expenses, paying yourself, and paying corporate tax, there's $200,000 sitting inside your corporation at year end. You think to yourself, I should invest this, but in what? You're not sure. You've got a lot on your plate running your business. You put that $200,000 into a savings account, you tell yourself you'll figure it out later. And then a year passes and you add another $150,000. The account now has $350,000. It's sitting in a savings account, maybe earning 1 to 2%. You think, next year I'll get this sorted. And then another year passes. Now you've got $600,000 sitting in that savings account. You've been thinking about building a portfolio, but you're not sure what type of investments to buy inside your corporation. You also might not be sure if it's better to hold them inside of your corporation or outside of it. You're not sure of the tax implications, and you're not sure about what you're missing. So it sits there, and it keeps sitting. After 10 years, you've accumulated $1.2 million, and it's just sitting in a savings account, earning next to nothing. Here's what that situation is costing you. First is inflation. Over the past decade, inflation averaged 2 to 3% per year. That $1.2 million is worth, in real terms, what maybe $900,000 was worth 10 years ago. Next is going to be opportunity cost. If that same money was invested in a diversified portfolio earning 5 or 6%, you'd have nearly $2 million instead of that 1.2. So that means you've lost out on about $800,000 in wealth creation. And then third, and this is the tax problem I mentioned, sitting on large amounts of corporate cash can actually create passive income triggers. The reason most business owners don't invest in retained earnings is because they don't understand how corporate investment income is taxed. And because you're so busy running your business and there's so much to know, the fear of messing up becomes intimidating. So let's start with the simplest. Interest income is usually paid by GICs, savings accounts, and bonds, and it's highly taxed. It's added to your corporation's taxable income at full value. And then we have dividends, which is just money that's being paid out from another corporation that you're investing in. And then we have capital gains that come from the growth of the value of the underlying investment. Now here's the wrinkle. When the investments inside your corporation generate income, especially interest income, the income is called passive income. And if you've watched my prior videos, you know that passive income can trigger a small business deduction clawback. So if you're a corporation that's generating $400,000 in active business income and you put a large bond portfolio inside of that corporation that's generating $70,000 in annual interest, you're in the passive income clawback zone. And in this case, you start to lose that small business rate on your active business income. And in my experience, that's one of the reasons why business owners hesitate to invest. They think, if I invest this cash, I'm gonna trigger taxes and lose my small business rate, so I'll just leave it in a savings account. But that logic is actually upside down. You're paying a much larger cost by not investing, especially because of the erosion of value over time. The trick is to invest in ways that generate capital gains or reinvested income rather than cash distributions. Here are the main options for deploying retained earnings inside of your corporation. Option 1 is corporate class mutual funds or ETF swaps. Instead of paying out investment income annually, they reinvest inside of the fund. Growth compounds tax sheltered, and then when you eventually sell the fund units, that's when you realize a capital gain. The end result is the same, you have more money, but the timing of the taxable event is completely different. This ultimately allows you to avoid annual passive income generation so that your small business rate isn't impacted. The second is growth stocks or growth ETFs, which are focused on capital gains or growth. Now, I do want to emphasize when it comes to ETFs, not all products are made the same. Some pay high distributions in interest or dividends. Others, similar to what I've mentioned before, minimize distributions and focus on capital appreciation. A diversified portfolio of growth-focused ETFs held in your corporation can generate reasonable returns without creating problematic passive income. And then we have option number 3, which is participating whole life insurance. This is a more sophisticated play, but it is quite powerful. In this case, your corporation buys a participating whole life policy on you, the owner's life. How it works is when you eventually pass, the death benefit is paid to your corporation and then flows through your estate through the capital dividend account completely tax-free. This strategy achieves 2 things. It moves money off the books of your corporation, avoiding passive income issues, and it creates an enormous tax-free wealth transfer vehicle. Now, the right option depends on your specific situation, so here are a few questions to ask. How much money are we talking about? What's your timeline, and do you need this money for retirement in 3 years or 20 years? What's your risk tolerance? Do you have any other investment accounts already? And what's your overall tax situation? So here's the insight that changes everything. The cost of doing nothing is usually higher than the cost of any of these strategies. So let me share a real situation to give you a little better context. I had a client who was an IT consulting firm owner here in Winnipeg. He'd been running his company for about 12 years. Over those 12 years, he'd accumulated approximately $800,000 in retained earnings. For all 12 years, the money had been sitting inside the corporate savings account, earning almost nothing. When we first talked about him investing it, he said, "I've thought about it, but I'm worried about tax implications." He'd read about the passive income clawback and wasn't sure if investing was going to make things worse instead of better. So I walked him through a detailed analysis. We looked at his corporate income. His active business income was running about $300,000 per year. We looked at his timeline. He was 48, thinking about retiring at 65, so roughly 17 years of runway. And then I ran two scenarios. Scenario 1 is leaving $800,000 in a savings account for the next 17 years, earning 0.5%. When we accounted for a conservative inflation at 2.5% annually, the real value of that $800,000 deteriorates. By the time he's ready to retire, in real purchasing power, the money is worth substantially less. And then there was scenario number 2, which is deploy the $800,000 into a combination of a participating whole life policy with $200,000 and the corporate class investment portfolio with the remaining $600,000. Whole life policy grows tax sheltered and eventually becomes a part of his estate plan. The investment portfolio is structured to minimize passive income, while it's also focused on capital gains and reinvestment income rather than annual distributions. Over the same projected 17 years, assuming a 5% return rate, the $600,000 invested in the investment portfolio grew to approximately $1.4 million, in addition to the whole life policy that had a substantial cash value and death benefit. The comparison difference ended up being enormous. And when we looked at the overall tax situation, the strategy actually improved his financial position. And that's what strategic capital deployment looks like. So if you have retained earnings sitting inside your corporation, whether it's $150,000 or $1.5 million, you need a deliberate strategy for deploying it. The strategy should be built around 3 things: your timeline, your overall tax situation, and your risk tolerance. It should be something you review annually, not just set up once and forget about it. It's also important that you have a good accountant and a strong wealth advisor. Your accountant will help you understand your overall corporate tax situation, and you can model the passive income implications of different investment structures. And then your advisor can help you choose the right structure and the right investment strategy within that overall structure. So if you're a business owner earning over $250,000 through your corporation, download my Business Owner Playbook. It's a short checklist of planning levers that quietly decide whether your corporation is working for you. Most business owners who run through it spot at least one area where they can keep more of what they've built. The link is in the description. If you found this video useful, hit that like button or drop a comment with what topic you'd like me to break down next. As always, please subscribe so videos just like this one show up in your feed. Until the next one, take care.